Hi guys, my name is Samuel Maina. I want to take this opportunity to thank you for giving me this opportunity to present my professionalism in FX market. Secondly, I want to apologize for not using the application that you told us to use because I tried using the application but I had problems recording my screen. That's why I opted to use the OBS that I normally use to present or create my videos. I hope you understand this. Thank you. Now, we shall be covering the pairs that we shall be covering are gold versus USD, Euro USD, GBP USD, USD JPY, and this is the overview of what we shall be covering in today's presentation. I've listed them down here so that I won't forget. Market analysis, pattern recognition, trend analysis, market timing, risk management, and of course we shall be staying up to date with the global market news so that we won't be caught up when the news comes up. Now, we need to check for the news, economic data release that could impact the asset that we shall be trading. That's the first thing we do before we get to the market. We check the news. Let's head over to Forex Factory and see if we have news. Now, there is news on Euro, high impact news, and okay, because it's a presentation, we'll use the Euro. There's this unemployment claim news. This normally happens every Thursday, every single Thursday. We normally have the unemployment claim, and probably in the next presentation I'll explain why we normally have this every Tuesday. I'll explain these numbers. Nice. Now let's head over to the charts. Analyzing the market, or the market analyzation. This is our first topic. We shall be looking at market structure, and this is pure price action. What we shall be looking at, we shall be looking at uptrend, downtrend, sideways or range, consolidation, and choppy market. We shall be using trend lines, support and resistance, head and shoulder. This is for reversal, double tops and double bottoms, and this is also for reversal. Now, as we can see, this is an uptrend. We know this how? Because the market was making higher high than the previous high, and lower high. Okay, let me repeat this. Apologies. We know this because the market is making higher high, and higher low, than the previous high and low. And this is how we determine that this is an uptrend. The next market structure that we shall be looking at is the downtrend. and we know this, that this is a downtrend through high, higher low, higher low, higher low, higher low, and lower lows, lower low, lower low than the previous low and high. This trend is broken when we have this trend is broken when the next high is higher than the previous high. Like here, this was higher high. Sorry, this is higher low, and this is another higher low. The next high was higher high than the previous high. Now the trend is broken. The next market structure that we shall be looking, and I'll do this faster so that I won't take much of your time. The next market structure that we shall be looking at is the sideways market or the range market, like here. Here, this is the range market. Here, this is a false breakout. This is what we call a false breakout. Now, the range market, the market did not cross the resistance level, and the market did not cross the support level. The market was in between the support and resistance levels. Now, this is what we call the range market. The next market structure that we shall be looking at is consolidation. Consolidation. Now let's head over to MT5. We can see here that we have a consolidation. So object, here the market was in consolidation. This means the market was accumulating orders, or sellers, because the market was going down, were taking their profit. That's why we had a consolidation over there. Now, after a consolidation, the market finds another trend, and you can see after this consolidation, the market went down. The market continued the downtrend. The next market structure that we shall be looking at is choppy market. Like here, choppy market. The market does not want to respect the trend line. The market doesn't want to respect the support and resistance levels. Now, this is a very dangerous market to trade, because you cannot anticipate where the market will be heading next. This happens when sellers and buyers are struggling for power. When we have a lot of sellers and buyers in the market, we normally have this kind of choppy market. We also experience this kind of market when there's news. For example, when there's, like I've shown you, the unemployment claim news. When there's news, we experience this kind of market. Now, let's look at head and shoulder for reversal pattern. Let's draw the head and shoulder, then I will explain. This is the first shoulder we have at the head, and the second shoulder. Now, this is a reversal strategy. When you have this kind of market, we wait for the market to test this level, the neckline level. This is called the neckline level. When the market tests the neckline level, now we know that this is a reversal. Let's look at double bottom. Double bottom. This is also a reversal kind of pattern. Now, when we have this kind of pattern, we wait for the market to test this zone. When the market tests the zone, then reverse, we know that this is a reversal pattern. Now, the next thing that we are going to look at is technical indicators. And we shall be looking at moving averages, MACD, Bollinger Bands and Keltner channels. They both work the same, but on this presentation we shall be using Keltner channel. We shall be also looking at parabolic SAR, Heiken-Ashi, and Fibonacci. Now, let's add the indicators. We shall start with moving average and MACD. Let's type in here moving average. We shall be using the moving average exponential. Let's remove this line. Exponential, and we will be using 50 EMA. This one will act as support and resistance level. Now the next MACD, the next indicator is MACD. Yeah, we shall be using this one, the moving average convergency divergency. Now this will help us identify the momentum, the bullish with the bearish trend. Now, let me explain here. When the MACD is above the price, it indicates that this is a downtrend, like here. Sorry, when the trend line is above the price, it indicates that this is a downtrend. And we confirm this by looking at the MACD. This is called the histogram. These candles. When the histogram is red, it means that it confirms that this is a downtrend. And the two lines should be facing down. So we look for moving average. When the moving average is above the price, in the MACD, the histogram is red, and the two lines are facing down. That indicates that the market is on a downtrend. Let's look for another example. Now, like here, when the trend line is below the price and facing up, the MACD is green, the histogram is green, and the lines are facing up. This indicates that this is an uptrend. I hope you understand this. This is a clear indication that the market is rising. Now, the next indicators or indicator that I shall be using is Kettner channel. This is to point out the entry and the exit point. Let's head over to MT5. Now let's add the Kettner channel to the chart. Sorry, go to indicators, custom, then we shall be able to see the Kettner channels. Let's make them a little bit thick. Nice. Now, when the market is above this line, the middle line, this line, it indicates that it is a downtrend. Like here, this was a clear indication that the market was going down, and to exit the market we need to wait for the middle line to cross the candles. When the middle line crosses the candles, it's an indication of the end of a trend. So if we were to enter here, we would have exited here. Let's look for another example. Like here, when the middle line is below the market, it indicates an uptrend, like here. And when the middle line crosses over the candles, like here, it indicates that this is the end of the trend. Now if we were to enter here, we would have exited here, this point. Now the next indicator that we shall be looking at is parabolic SAR, and we shall be using Heiken-Ashi candles. Let's add the parabolic SAR. Let's make it thicker. Now let's add Heiken-Ashi candles. Okay, nice. Great. Now To identify that this is an uptrend or an entry point, the parabolic, if it's an uptrend, the parabolic SAR dot should be below the market. Like here, the parabolic should be below the market. And the Heiken Ashi candles should be blue. This is an indication that the market is rising and our entry point should be somewhere here. Now, to exit this market, we need to wait and see a parabolic above the market, and the candle should change to red. So this will be our exit point. Let's look for another example. Now, to identify that this is a downtrend, or our entry, a sell entry, we need to see a parabolic dot above the price, like here. Then the price should be red, but here you should have been exited here. See, because there's a parabolic here, and the market and the candles tend to turn to blue. If we could have entered the market here, where the parabolic is above the price and the candles are red, we could have exited here where the parabolic is below the price and the candle has changed to blue here. This will be our exit point. Now, the last indicator that we shall be looking at is Fibonacci retracement, and this is for reversal, and we shall be focusing on a magical area. We shall be focusing on a magical area which is 61.8. Okay, let's use the 4 hours. Now, this is a reversal strategy. We shall be looking at this area. I like to use zones. I like using zones. So let's draw a zone here. Oh, nice. Now we shall be focusing at this zone. Now, because this zone has been tested a couple of times, and the market, let's say the market probably is here and the market is going down. Now we take our parabolic tool and place it here. So when the market gets to our zone here, the magical area, which is 61.8, this is the magical area, then it bounced back, we know that this was a reversal. The market is going to rise, and this is a powerful tool, the parabolic. Now The last thing that we shall be talking about is risk management and trade idea. Let's head over to, let's come over here. Now, you should not risk more than 3%. If you're trading, if your account has $100 or $500, you need to use a mini lot of you need to use a volume of 0.02 or 0.03 if you have $500 in your account. Now, let's assume that this is a live trading and the market is at this point. The market is at this point and the market has tested this zone. Let me draw a zone. The market has tested this zone couple of times. Now we want to get a clear entry of where we'll get into the market. Okay. Now this strategy is called the break and retest. It's a very, very powerful strategy that traders normally use. Now, here, you see, because it's a powerful zone, the market broke the zone, then it tested the zone here. And because the zone has been tested a couple of times, we understand that this is a powerful zone. So when the market tests and bounce back, this is a very, very nice place to enter our market. Let's go long here. This is where we are going to enter the market, and our first take profit should, let's say our first take profit should be up above our previous high, slightly above our previous high. That is our first take profit, that line. Our second take profit will be above our second higher high there, and our stop loss should be below the previous lower low here. Now let's place our order. Our stop loss there, and our take profit there. Now let's see how this works. Our first take profit is hit. Our second take profit is also hit. This is a very powerful strategy that professional traders use, the break and retest strategy. One of the most powerful strategy that I personally use on my trading. It works like every time. Now, ladies and gentlemen, that was it. That is what I wanted to cover on this presentation. If you require any other information or clarification, please don't hesitate to reach out. Thank you for listening, and I really appreciate this opportunity. Thank you so much.